So for the past 2 weeks, I've been getting a lot of messages privately and also requests in the Facebook group for me to talk about the Russia situation and what I think about the surge in oil price, commodity price, and also what I think will happen in the Canadian housing market moving forward in this year. So if you're interested about all these, then keep watching this video. Now, before we start, if you haven't already, please help us like this video and also subscribe to this channel. I noticed that a lot of the viewers on this channel haven't been subscribing. So if you could please subscribe, it really helps us out and help us with the YouTube algorithm. All right, now without further ado, let's jump into today's video. So as we all know, the Russians' invasion over Ukraine has been going on for 3 weeks now. Now, originally, the world thought this was going to be a 2 to 3 day operation, judging from previous invasions, Crimea, Georgia, example. They were met with little to no resistance, and this was over before the Western countries could even react to it. But instead, the Ukrainians have been putting up a fierce defense and response to this invasion, and now it has united most of the world to put up a lot of sanctions against Russia. Now, obviously, one of the most important sanctions was removing Russia from SWIFT and also banning its import of Russian oil. This is essentially what caused a huge surge in oil prices recently. So let's first talk about oil price and where do we think it's gonna go moving forward. Now, just to give you guys a little bit background and kind of overview of this current situation, why Russian oil is important and why does banning it have a huge effect on the worldwide crude oil price. Russia is actually the third largest oil producer after USA and Saudi Arabia. They produce roughly 10% of the world's global supply. However, distribution is not even. US really only relies on Russia for about 3% of its oil consumption, about 600,000 barrels a day, while places like Canada virtually does not import Russian oil and hasn't really been importing for the last couple years. So most of this reliance actually comes from Europe, which relies on Russia for about a third of their energy consumption. Now, some places like Germany, it's a little bit higher, it's about 50%, which also explains, if you were to look at political decisions for the last couple of weeks, why some countries in Europe are a little bit more hesitant to act versus the others. Now, the natural question to ask is then, well, can't just US and Saudi or other countries that are producing oil simply pump up their production a little bit more and cover what's missing from Russia? The answer is yes, they absolutely can, but it's not as simple as that. So let's talk about US first. Now, US is actually trying to ramp up production, I'm sure, but there is multiple factors affecting its ability to ramp up quickly. The first one would be fewer drilling sites. So US has gone through a shale boom in the late 2000s. Fracking from shale layer boosted US into world's largest oil producer. This renewed dominance also helped push down oil price as US took market share from OPEC. US was able to supply more to the world while importing less from Middle East and North Africa. But by early 2022, US growth is slowing down even before the invasion as there are less drilling sites available. Even before COVID started, US had lowered its production on purpose already because investors from these oil companies were demanding better performance from them and also a higher dividend payment. And in order to do that, they have to maintain oil at a more controllable level. They can't let it drop too low, which we saw during COVID time already. It dropped almost to negative price. And this is just basic demand and supply. When demand is so low because of COVID, supply also has to drop significantly in order to maintain a higher sustainable price level, which then actually creates the next problem that we're seeing today is the shortage in staff and also sand to refine the oil. As we said, COVID basically sent oil to negative price. Because of this, tens of thousands of oil workers were laid off, not just in US, but we also see the same thing in Canada as well. And because COVID is 2 years officially, so laid off basically what happened 2 years ago. So for the past 2 to 3 years, many of these oil workers couldn't find a job and they were forced to leave this field, venture into something else in order to survive. So now even if you want to ramp up production, all those people that have left the field already, many of them are probably pretty experienced. It's gonna take you a lot of time and resource to retrain a new batch or to headhunt them back into the industry, which I'm sure most of them after being laid off probably feel that this field is not very sustainable, it's not very safe. Many of them probably don't even want to come back. So we're going to take a lot of time to retrain new people to help with production. Now, moreover, due to supply chain shock, there is also a shortage of sand necessary for puncturing the hard shale in order to capture the oil stored in the rocks. So we're facing with logistic problem and also manpower problem. And finally, the third factor hindering US from pumping up their oil production is the antitrust law. Unlike OPEC, which acts more like a cartel and they can, coordinate and control production that way, US companies are actually bounded by the antitrust law within the country, which means they cannot coordinate with other companies to manage output. Also, they're private companies, so the US government can't simply order them to just produce more. It has to also make sense for them financially in order to do that, because at the end of the day, they answer to the shareholders, not the US government. So if US is trying but having a difficult time to ramp up its production, who else then can come in and replace the void? Right now, only a few countries have the ability to boost production significantly, and they all have to work together for this to completely work out. Now, these countries are Saudi/UAE, Iran, US, and Venezuela. Each of these countries obviously have their own agenda and condition to fulfill before they're willing to increase output significantly. For example, Saudi is part of the OPEC organization, which also has Russia in it. On the other hand, Iran mostly just cares about its nuclear weapon development. This is why they also have a massive sanction on themselves. So if you want them to increase their production, likely US will have to negotiate with them, allow them to develop some sort of weapons, or lift some of these sanctions. And same thing with Venezuela, which also got hit with a massive sanction due to super amount of corruptions and just mismanagement of the country, a dictatorship basically. They also are looking at a lift in their sanction, likely in exchange for increase in production. So it's not impossible for countries to come together and really replace supply for in terms of oil, but it's gonna be difficult. It takes a lot of negotiation. At least publicly, they're not producing more oil, so they claim. But privately, maybe they have already ramped up production to try to make as much money as possible on this high oil price, before the inventory really starts to show that, hey, these countries are actually ramping up production secretly. I don't know, these are like some of the conspiracy theory or people's theorizing on the internet, but I think it has some sense to it. So we may see things, already ramping up. We just don't see it publicly on paper. For everything I'm talking about so far, it has been summarized very nicely in 2 New York Times article, which I will link in the description below. So if you want to give it a full read, check out the link in the description. So next, let's talk about how long will this high oil price or high commodity price likely to last. Now, obviously, nobody knows. This is just my personal opinion, but I really think it's gonna last at most 3 months to maybe 6 months max. If we look at the historical price chart of crude oil, we can see that in the history, it has only once punctured above slightly $120, but for every time it has a massive spike in prices, it does not last more than 3 months. Now, I think there are 3 major reasons why this is happening. Number one, with oil being the foundation of basically every infrastructure, everything in the world right now, the world needs oil to run, basically. If oil price is too high, it could send every country back to recession. It makes no economic sense for companies to operate anymore if oil is going to eat away most of its profit. And if they're not operating at the same level, they're going to lay off staff, unemployment is going to go up, and then we're back to recession. And once we're in recession, the oil might plummet again, which is also why recently, you start to see articles online asking government to maybe think about not raising rates too quickly. Now, reason number 2 is too high oil price actually hurts oil producing company. Now, with high oil price right now, I'm sure one of the topics that keeps popping up more frequently in the recent times is the idea of buying an EV. At least for myself, I've heard of the idea of buying EV probably 5 or 10 times more than what I used to hear when I talk with my friends. And actually, every time there's an oil shock, it pushes more consumers around the world to fundamentally change the preference when it comes to purchasing, especially when it comes to cars. In fact, there is an article that came out echoing the same concern from Middle East producers. They also know if oil price is too high for a sustained amount of time, it might benefit them in the short run, But in the long term, they know it's going to hurt the demand in oil because more and more people, it's going to be convinced to go over to the EV side. Which is why I think sooner or later, these oil producing countries, it's going to ramp up its production because they want oil at an elevated, sustainable level, but not this high. Now, the last reason is high oil price will lead to a much higher inflation, which will put even more pressure onto its governments. People around the country right now are already complaining about consistently high inflation. Government said it's transitory. It looks like it's not transitory. Increasing oil price is just going to add to this pressure. More people is going to complain, and countries will be hard pressed to come up with a solution as soon as possible. Rather, like I said, it's via negotiation with some of these oil producing countries that have been sanctioned, or simply they need to release more of the oil reserve to control the price. US alone, last I read, has 50 billion barrels, and I think the Western countries have a total of 150 billion barrels at their reserve. So if they really get hard pressed to do something about the oil price right now, they could tap into some of these reserves, which can last us quite a long time. But nevertheless, high oil price right now definitely creates a turmoil in the stock market, especially if you look at the indexes, we have been dropping for 5 weeks straight. So before we jump into the housing situation, a little bit of investment advice. And one of the best quotes I like to refer to consistently is from Warren Buffett, is to be greedy when others are fearful and be fearful when others are greedy. Right now is really a great time to invest, but you have to take it slow. Looking at the VIX index, which is an indication of volatility, we can see it's extremely high, probably twice as high as the normal range, and we're halfway there to a COVID peak. Now, usually when VIX is this high, it indicates fear. So right now, market is going to act irrationally. You can do as much research as you want, as much reading as you want, but the truth is, market is not going to act rationally. So for new money, just dollar cost average in and make sure you diversify and take it slow. Don't rush it in. If there's a one day of a big dip, like 5 to 10% suddenly, then yeah, maybe you can put a little bit more in. But on the normal days, just dollar cost average and take it slow. And for the existing money that you have been invested already, just stay put and don't panic sell. I also advise against you selling all the things that are down right now and go into oil or commodity or precious metal just because it's ramping up over there. I think you definitely should have some diversification into that side, as with all healthy portfolios. But I think it's too late to go heavy into it. It's really at its peak and it's very high right now. And as we saw in the chart, every time oil price is this high, within 3 months, it will crash back down. I'm not saying it will definitely happen again, but history does have its pattern, and you're going to be very careful if you're going to go all in or heavy into oil. Don't try to trade your way out of these kind of current down market. The more you try, the more poor decisions you're going to make, and you're probably going to end up losing even more money than before. All right, so now with that done, let's talk about house inflation and housing market. Before we do that, if you haven't already, make sure you join our private Facebook group. We have close to 5,000 private members right now. And in there, I'm going to be posting other content. You can also ask questions where our other members or myself will be able to answer you as well. A lot of people have given me feedback and told me that this group is really, really helpful for the financial literacy and also just getting questions across the board. So if you haven't joined already, make sure you click the link in the description below and request to join. Now for this part, I don't want to jump into each city and look at the numbers like I usually do. The reason why is because the situation right now is very similar to a month ago. So last time I already made a video over here if you haven't, check it out over there. But I think right now there's not much change, so it's pointless for me to waste your time and talk about the same thing again. So instead what I want to do is talk about the macro outlook and trend, and also my own perspective as an immigrant / Canadian who have also been tracking not just the current house price, but also Asia's house prices as well. So I want to offer some perspective from that angle. So for house prices, that's basically 5 factors we need to consider to determine what direction the house price is going to go. Now, the first 4 factors pretty much all pointing towards a higher prices. We have increasing demand, especially increasing population. Canada is top population growth among G7 countries. We aim for 400,000 immigrants a year starting this year. So it's going to be a lot of people coming into Canada. Now, with high inflation costs, it's also unattractive for at least small builders to start building. And like we said, approval process is painfully slow. Places like Toronto has the green belt, which basically restrict and corners everyone into the same place. Employment is also recovering, is pretty strong. Now, we just said that no, if oil price is too high, we can go into recession. So maybe employment thing will change, but at least right now, it seems to be pretty strong. And with strong employment comes strong demand for housing. However, even though these four factors seem to indicate the house prices is going to continue to go up due to strong demand, lack of supply, I want to exert caution for anyone who is still overly excited about real estate. I really think there are two factors out here that's a little bit hidden, but it can put a massive downward pressure on the price in real estate. The first one is financing costs, and the second one is market sentiment. So let's talk about each one in detail. Now, we have seen house prices stagnate and even drop in the past, notably 2017 or 2018, especially for detached homes. Most of the experts will correlate this to interest rate being, above 3%. That's really when it starts to hit all homeowners when it comes to financing cost. While that is true, if we're just looking at the housing costs, one thing we have to factor in is inflation wasn't this high back then when house prices stagnated. It was at the usual 2%-ish or below. Right now, we're sitting at 4, 5, 6, 7% inflation a year. So what that means is not only people's housing costs is getting hit from the increase in interest rate, everything else related to it and everything not related to it is increasing as well. I have a client that just replaced the sewage system. It was estimated to be, I think, $35,000. At the end, I think he's ended up spending $60,000 just because of how little supply there is right now. Which is why I think with this consistent high inflation, we're no longer looking at the 3% as a magic number before the house price may stagnate. I think it's going to happen a lot sooner than that because people are already being squeezed from all sides. And with Russia's invasion, it does complicate things. Without Russia before, personally, I think that inflation is likely going to peak in around April and May, and then it will slowly drop back down as everything is opening up slowly. But recent high spike in oil price, even if it's not sustained for a long time, is likely going to push the peak of inflation into June, July, or August, which is going to put even more pressure on everyone else, especially the people that kind of drove until you qualify that live very far away, and now maybe work from home is ending and you have to drive all the way back to the office. Now, the second factor is the market sentiment, and this is something I think all real estate owners, especially the people that kind of bought the investments right now at a negative cash flow, thinking it's going to go up another 20-30%. That's how you gain profit and that's how you cash out. You need to understand what I'm about to say. A lot of people I hear all the time is, hey, they're saying, hey, I need to go out there, I need to buy condo, I need to buy detached home because it went up 20%, double digit for the last 3-4 years. And if I buy this right now, it's gonna worth X and X amount in the future. So let's say all these assumptions are true, and let's take the lowest, most conservative double-digit gain, then that's the 10% a year consistently. A 2 mil home is going to worth about 5 mil in 10 years using this kind of logic, and 13 mil in 20 years, and 34 million in 30 years. Now, looking at this number, we know it doesn't make sense. It simply cannot be worth that much. It's one thing from a home to worth 1 mil to grow to 2 mil, then for something to worth 2 mil and grow to 5 and then 13 and then 34. Because the truth is, wages, and no matter how hard you save, how much you work, simply can't keep up with these prices, and eventually no one will be able to afford such home. Somewhere along the line, it has to stop, it has to slow down. There is actually an invisible ceiling that someday we'll hit, and then once we hit it, we'll realize it doesn't go up anymore for quite some time until many years in the future. So we have to keep this in mind. Now, personally, I think the highest invisible ceiling that exists that will hit is when even the immigrants deem the homes not worth buying into, or they get too much pressure financing it. Now, for the following, keep in mind I don't have a lot of hard stats to back this up. This is just coming from my own perspective as an immigrant that came to Canada when I was very, very young, and also someone that owns a home here, and also have been tracking the Asia's house prices because I do go back quite a bit of times. So I do kind of understand both sides and what people are paying on each side. So this is just my perspective. Now, in 2019 CBC article reported on a survey done by Ro LePage. In there, they said 1 in 5 homes are bought by immigrants. Though their definition of immigrants is kind of loose, they included anyone that moved into Canada within the last 10 years. But nevertheless, survey from the 2018 census also show similar findings. For example, in BC, it was 35% buyer being immigrants. But that was a couple years ago. After COVID, by now, I would imagine this percentage probably went up significantly, especially with the huge increase in immigration. And this is probably especially true in the detached home space. Now, while most of these immigrants likely will have a much higher budget than an average Canadian, they do have their limit as well. Take Hong Kong, for example, which is where I came from. An average 3-bedroom condo in an average location, kind of like Coquitlam equivalent, averages probably 7 to 10 million Hong Kong dollar, which is around 1.7 million Canadian. And this is for a 3-bedroom. If it's at a better places like Central, mid-level, for example, which is equivalent to our downtown or Vancouver West, then these kind of 3-bedroom condo, we're looking at double the price easily. Which means it's pretty common for family to sell their places, move over to Canada after pay off some of their mortgage, still left with at least 1.5 to 2 mil Canadian dollar cash, and with a little bit of lending, this puts their budget to around 2 to 3 million for their home. But if even a 4 to 5 bedroom detached home, we're talking about kind of the basic ones, not even the super luxurious ones, are gonna cost at least 2 to 2.5 million, like we're seeing in Vancouver right now, even immigrants with strong financing and down payment will have to think twice before they put down an offer. Now, we're not at the spot where even, we're seeing obviously immigrants are backing off as well, but if inflation is going to be consistent and prolonged with increasing rates and stock market is dropping, then we might see this happening sooner than later. So I think personally that for Q2, we're still likely going to see house prices go up, but probably not as much as Q1. It's going to start to slow down in terms of the growth. And if inflation doesn't change, if we're really increasing interest rate every quarter at least, then probably by Q3, we're really going to start to expect price to stagnate and plateau a little bit. Most people are going to be wait and see and thinking twice before they put down an offer. And Q4 likely will start to see a slow decline in house prices. But even with that said, I think if you're looking to buy for your own right now, it's still okay. As long as you are comfortable with the budget, comfortable with the finances, I think it's still a good time to buy because you're going to be in there for a long time. One thing I would do, which I have been doing with a lot of my clients, is I would really go through the budget in detail and then add 1%, 1.5, or even 2% on your mortgages. And then ask yourself, can you handle these kind of payment if it really happens like this? Either you probably have to buy a smaller home, right? Make some compromises, buy an older home, instead of stretching your budget to the max and assuming whatever number you have right now is still going to stay true. Very likely it's going to be very different a year from now. So I think self-owned is still fine for investment. I personally won't do it anymore. For example, I'm in Vancouver, I'm looking at a pre-sale condo, 1-bedroom, we're looking at 600K, some are even 650K. For me, it's definitely deep negative cash flow, and I will be expecting someone to buy it off my hand at, at least 800K for me to consider it a worthwhile investment. And currently, I just don't really see anyone willing to put 800K. Who knows, I might be completely wrong. I'm sure people say that the same thing 10 years ago. But I think there is going to be an invisible ceiling, and I think we're getting very close to that ceiling. So as always, do more research, think twice, do a better budgeting before you make any moves. Now, that's all I want to share today. If you like what I'm sharing, make sure you hit the like button for me once. If you don't like what I'm sharing, hit the dislike button twice. Next one I want to hear from you is what you think about Russia, oil, inflation, and also the housing market in Canada. Where do you see the world going right now? Let me know in the comment down below. If you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel. Click the bell button so you get all the notifications in the future. Alright, this is Jackie Cole. I hope you found this interesting. I'll see you next week. Bye.